Hey, I just wanted to do another quick video on time frames and which ones to pay attention to. And the answer is you can pay attention to whatever you want. These work on all time frames, no matter what it is. We have a joke, one of my friends and me, about the 47-minute time frame, which is, um, you know, it's a joke time frame, but it still works for charting because the time frame is completely irrelevant unless you're trying to track what certain people are doing, what the majority of people are doing in particular tickers. So, like often the 5 minute and the 10 minute will have pretty big reactions because right around those candles, when the candles are finished forming and ready to form the next one, you'll see a burst of price action around them. But other than that, it doesn't really matter. So here's a 47-minute chart, and you can see that it's like each of these. This one is like the very first tail off of it, off this the first candle off of the bottom is where that starts, and then the next one is a couple later, and this is the valid one up until price comes back down to this point. Actually, up until price comes down to this point, these are still valid, and you can see that they're actually getting respect on this self same. It's as long as it's the same chart, it's going to get respect. I mean, that's what you're looking for, these areas where it respects, and it literally doesn't matter where you draw these lines. I mean, what you're looking for is the trend. The trend originates here, and that's what really matters. But you're going to have the most price action interaction later when you're drawing it off of real um, pivot points. And so, the whole trough to trough pivot point is going to be the strongest one. And sure enough, that's when price falls. That's where it dumps. And this is because on any time frame, these scales are going to work, because that's the nature of technical analysis. That's how it works. We're plotting out trends. So you can see on the 1 minute chart that these don't line up. And this is why I like to use the 1 minute chart, and I prefer it over other charts because it's the finest grain, at least on TOS, that you can get, and line it up exactly, because this is the middle of a 47-minute candle, and this is where the peak or the trough of that 47-minute candle, which actually happened a little bit later, but because candles are symmetrical, it draws the candle in however wide the 47-minute would be, and then draws it directly in the center of that. Like if you zoom in on this, you can see like I'm in the center of that candle now, and if I go out to the side, the candle starts here and ends here. And if you look down at this, you can see that's where it starts, that's where it ends, and the middle of it is right here. So the lines don't exactly line up on the 1 minute chart. I mean, they're pretty far off. So what's interesting is if you go into like a 1 minute chart, I've drawn these lines in. I've kept the two here. Let's just maximize this so you can zoom in and see. I've kept the two solid lines, but the dashed lines are the ones that I drew on the 1 minute chart from back here. And I think that this is the first touch was over here somewhere, and the second touch was over here. And if you draw these forward, the way they interact with that same price is more exact, because the 1 minute is going to have its peaks and troughs in closer to the point where that price actually happened there. And you could do this on a tick chart if you want to get exact, and you can see how much it respects it. Like much later, even this happens on one day, and then it gets respect on a completely different day, and it bounces off of this trend. And if you push this forward even further, you can see, like, so I made these a little bit lighter because they're historical trends of, at this point it was still valid, and so I was drawing these in and keeping these in place so you can see how price is interacting with it. So they give you levels to look for and predict a possible turn. And even all the way out to here, it's still getting some respect. So what I want to look at though is once it gets all the way up, and starts to turn, that's the spot where it reacts. But the two that are the two more solid ones, so on the 47-minute chart, it doesn't line up exactly, and so like there's not really a lot of correlation here on the 1 minute chart, but on the 47-minute chart it looks great, because that's a bigger trend. And then we're looking at the 1 minute chart here, and that's where price actually starts to interact and turn. I mean, this is almost exactly, and I bet you could find a chart where this is exact, And that's the one I would use for these longer term. I mean, you can sort of do some chart shopping to find ones that interact better. But it could just be price action just crashing through and trying to do something here that's related to some other chart feature, because price wants to be near a chart feature no matter what. Like in correlating things like ES and Apple, for example, ES would make a move, Apple would make a similar move because they are correlated highly. But when ES would stop at its level that mattered, Apple would either keep going a little bit or stop a little sooner at a level that mattered more to Apple. So they're not direct one-to-one correlations. But the action is the action of moving down to the next level down, and it's your job to figure out what those levels are. And this can help you do it by looking at the 1 minute to get a more precise look at the internal price action and how it's moving with this compared to a different, like, arbitrary level, and it may get more respect on a 10-minute level, just because more people are looking at the 10-minute level, and all of that stuff adding up together makes a difference. But people are all looking at price in so many different ways that what we're trying to do is find high degrees of correlation between lots of different ways. And so that's like one of the rules I have before entering a trade is whether or not I have three reasons to get in, and that's whether it's hitting a trend line, whether there's a horizontal price level, whether there's an EMA or something. It doesn't matter what they are, but I want to see a couple of pieces of correlation before I'll trust any particular level. And that's why I have so much junk on my charts, because I just want to look at the most possible levels of correlation between these different indicators, different unrelated indicators, because there's a higher probability of success for those, because the more you use, the more people are trading off of those, and the more that will be the local price area where things switch. But again, I mean, up here, I think there was a trend line that I'd drawn up here that this had broken through, and that's not the reason it fell so much. It fell so much because I think there was a negative FOMC here, and that provided the direction and the velocity of this move. So that was a big enough push that it knocked it way out of its orbit, and it came crashing through all of the levels that are in between here. I guarantee you there's all kinds of price structure that it just didn't even pay attention to. It ignored it all the way down until it gets down to a far enough level, because that's how much this news announcement mattered. That's how much velocity imparted to this move. It was negative news of such significance that it pushed it down all the way through all this stuff, and then it kept going. I mean, buyers kept trying to find the bottom, and it kept, they're basing their risk off of various levels, and as it crashed through those levels, they would cover their positions and try again. And that kept happening and kept happening and kept happening, and there's no way to predict which level it'll be, but you can definitely find levels that matter more than others. Like this level matters more than others, and this is whatever 4016 or 17-ish, and you can tell that by looking at the chart after the fact. But there's probably some level here, and again, it's your job to find these levels before they happen and start trying to figure out which ones may be strong enough levels to actually reverse that price action. But when you see it rebounding from a level and then crashing through that level and later on retesting the bottom of it, that this is not, once it rebounds off of this, it's not going to make it above this again unless it tries to actually turn around and retest it again. So you're pretty safe staying in a short. Like if you were to just jump in on this, knowing that this was already a line and get in on it short, you're just risking off of this line. If it gets above it, then it broke, and if it doesn't, then you just stay in. I mean, it's not coming back up. There's no reason to get out here necessarily, or even here, because it doesn't really reach up to the level. And if you've got this line drawn in, this may be another area of entry where you're looking at this saying, well, it crashed through and now it's retesting, so I'm going to try it here and risk off of it. If it goes above, then I get out, but if it goes below, now I'm in. And once you're in, all you need to do is look for a reason to stay in, look for a reason to get out, and that's all you have to worry about. Or you can, you can use profit targets. Like if you're risking this much and it makes this much of a move, that's still a good move. I mean, if that's what your plan is. But I thought it was kind of fascinating though that you can use any. This will work on any time frame. Literally any time frame will work, and you'll see these areas of confluence with it, because what matters more is the origin point. That's the 1 point perspective here. That's the beginning of the trend. Everything else is just price reacting to that origin point and seeing what the relative strength of that trend is. But all of those tests are based on that entry point. That origin way back when. And because we have lots of different origins, it's like ripples in a pond, and we're looking for ripples that, if you have one stone that you throw in and it creates wider and wider ripples, and then you throw another stone in the same spot, those ripples will be even stronger. And if you throw it in a different spot, they will, where they interact, they can either amplify or cancel out. And this is the same thing. So on different time frames, you'll have trend line reasons for price to turn, but then on other time frames, they may be trying to fight against that, or with other indicators or with other levels. I mean, there's lots of reasons why price moves, like what creates ripples in the price stream. And it's all a matter of trying to figure out, like, there's this initial move that gives it the velocity and direction, and then we just need to figure out how it interacts with these ripples and how that can slow down and turn price action. So try it on lots of different levels or scales and see what you get.